Welcome to Valley of the Sun Real Estate Show. Anything and everything you need to know when it comes to your real estate needs right here in the state of Arizona. Hosted by Jason Bates, the lender who has been known to take a turn down and turn it around into an approval.
Hello and welcome to Valley of the Sun Real Estate Show. I'm your host, Jason Bates, the lender who's been known to take a turn down and turn it around into an approval. Thank you so much for downloading the show today. I really appreciate you taking time out of your day to listen to what I have to say. And hopefully you'll get something out of this show today, or get as much out of it as I put into it. And I do put a lot into the show. So I hope that you get out of it what you're looking to get out of it. And certainly, if you want to reach out to me, if you have any questions or any concerns or anything that may be related to today's topic or anything related to real estate here in the Valley of the Sun or Phoenix, Arizona, you can certainly call me at 602-573-3101, or you can reach out to me via email at valleyofthesunrealestateshow@gmail.com. So today's topic is applying for a loan after a bankruptcy, or buying a home after a bankruptcy. And I get approached about this quite often from home buyers, prospective home buyers, and they just are. It seems as though when you file bankruptcy, your ego gets hit, and you just feel like you're at the scum of the earth, and you just don't feel worthy of home ownership anymore. Well, I'm here to tell you that you do deserve and should look at purchasing a home. Now, the purpose of today's show is to let you know what lenders are looking for, so that you can prepare yourself, so that when you are ready to purchase, you're going to hear the word yes, you're approved, rather than no, I can't help you. And so we definitely want that to happen for you. So with that being said, we want to get right into it here. So let's first start off here by stating what the two differences are between the two different types of bankruptcies, because there are two different types of bankruptcies. There's a Chapter 7. A Chapter 7 is when you have all of your debts liquidated. Nothing, you don't pay back anything. You don't have to pay the trustee. You don't have to do anything. All the debts are liquidated. A lot of times you're given back some of the items that you may have financed, such as an automobile, if there's some equity in the automobile, or any type of asset, you may have to give that back to pay back the bankruptcy. And then we have a Chapter 13. A Chapter 13 is when you're paying the trustee to pay back your creditors at a reduced rate, reduced payment, and a reduced amount that you may owe them. So, and that's generally over a 5-year period that you're going to pay back on a Chapter 13. So, with that being said, I'm going to go through each different type of loan and tell you and let you know what the parameters are for each one of those types of bankruptcies. Okay, so let's get right into this. All right, so on a conventional loan. Now, conventional loan is a Fannie Mae, Freddie Mac loan, and that is, if you're putting 5% down, sometimes 20% down, that sort of things. Your traditional 30-year fixed in most cases, although you can have different terms and things like that, but your traditional mortgage loan. A bankruptcy Chapter 7, it's 4 years from the discharge date of the bankruptcy on a Chapter 7. That's 4 years, not 4 years from the filing date, but 4 years from the discharge date before you can apply for a loan. Now, you can get under contract. You just can't close until after your 4th year. So let's say your 4th year, your date or your anniversary date is, say, September 30th. Okay, but you get under contract. You can look at a home and get under contract September 15th, but you can't close on the home until after September 30th. So you could close in November or October 1st if you like. No problem. You just can't close before that 4-year anniversary date. Now, the other thing with this, and this is something that we're going to kind of get into a little bit, you can get into a home with 2 years from the discharge date of the Chapter 7, provided you have extenuating circumstances. Now, extenuating circumstances is a little bit of a moving target, okay? Extenuating circumstances on a conventional loan might be non-reoccurring events that are beyond the borrower's control that result in a sudden and significant and prolonged reduction in income or a catastrophic increase in financial obligations. So what does that mean, right? So what that means is if you got in a car accident and you were unable to work and you have mounting medical bills, that's an extenuating circumstance. Okay, it's all going to be documented. We just can't say it. And there are some HIPAA laws in there that we can't get too crazy on. But if you have a certain situation like that, and now you're healed and you're back to work and everything's good to go, and maybe you're on disability even, because you can't qualify with disability income, then you may qualify for a home loan under conventional financing within the 4-year period. You only have to wait 2 years. And a lot of times on these situations, they want to see reestablished credit. So it's not just filing bankruptcy and then never applying for credit again. You want to get that credit reestablished fairly quickly from the time that your bankruptcy is discharged. Now, sticking with conventional here on a Chapter 13, and this is where the debts are paid back on a monthly scheduled payment plan by you to the trustee. And it's 2 years from the discharge date of the Chapter 13. So if you're in a Chapter 13, you've been paying on it for 5 years, it's not discharged until that 5th year, till when you're done with that payment plan. So that's 2 years from that date. So 2 years from your discharge date, and it's 4 years from the dismissal date. So sometimes you get into a bankruptcy, Chapter 13, and it can be dismissed for various different reasons. Well, it's going to be 4 years from that dismissal date before you can apply for a conventional loan. Now, moving over to an FHA loan for Chapter 7. And again, a Chapter 7 is when debts are discharged through the bankruptcy and you don't have to pay any of the debts back. It's going to be 2 years from the date of the discharge with reestablished credit, and you paid as agreed on that credit. So very important here that you get yourself reestablished with credit after you file a bankruptcy as soon as you can. As soon as you get discharged, get out and get a secure credit card and start paying on that. Doesn't have to be a whole lot. You just have to have that one secure credit card, and then you should be good to go. The other thing, debts. Let's back up here. So the debts on the Chapter 7, it's 2 years. Remember that. Now you can go less than 2 years, but not less than 12 months from the date of discharge. And that can be acceptable with those extenuating circumstances. Okay, now FHA is a little bit different on the extenuating circumstances because conventional Freddie Mac, you can have a divorce, and that could be an extenuating circumstance. Not many people know that, but a divorce does qualify under conventional. But FHA, a divorce does not qualify. So FHA, Federal Housing Administration, looks at extenuating circumstances as a serious illness or a death of a primary wage earner. Divorce and the inability to sell a property due to a job transfer or relocation to another area does not qualify as an acceptable extenuating circumstance. So very important there. There's a bit of a difference there. So when I'm doing the interview with you and going through your file with you, I'm going to be asking these types of questions so that we know what the best loan is for you. And so, I don't mean to pry into your personal business or anything like that. We just want to get the clear picture as to where you stand so that we can present you with the best possible options for you and your situation. Now, on to Chapter 13 for FHA. So, Chapter 13, FHA, again, Chapter 13 is when you're paying back the debts that you owed on a monthly scheduled basis to the trustee. And that's going to be 1 year from the payout period under the bankruptcy. And your payment performance has been satisfactory. So this is a little different. So not many people know this. If you're in Chapter 13, which isn't a very common chapter, form of bankruptcy, most people go Chapter 7 because they just want to get the demons, if you will, behind them and kind of move on with their lives. But if you're in a Chapter 13, you actually can get a loan 1 year after you started making those payment plans. So like I said earlier, typically you're in a 5-year payment plan on a Chapter 13. And you can actually, on a Chapter 13 under FHA, after the first year, within that 5-year period, after the first year, you can apply for a loan. Now, it is important to note here that you do have to notify your trustee that you're applying for a loan. And so that can be a little difficult. You got to convince your trustee that you're paying, or they're able to pay on that loan. So that's important to note there too. So, keep that in mind. It's not going to be just something, hey, I got a loan and I'm in Chapter 13 and I'm just going to go out and apply for a loan. That could hurt your bankruptcy. So it's important that you follow the rules on the bankruptcy as far as that goes. So now that's the conventional and the FHA. So there are some distinct differences there on that. And then let's jump over to a VA loan. Now, VA is pretty simple. And I know not everybody qualifies. You have to be a veteran, obviously, prior service in the military to qualify for VA. But VA on a Chapter 7 is only 2 years from the discharge date. And it can be 12 to 23 months, so a year to 2 years from the discharge date. If you have reestablished credit and paid as agreed and was not caused by acceptable extenuating circumstances. So you do have extenuating circumstances before you can get a loan within that 2-year period. And on a VA, extenuating circumstances, again, are a little bit different. And they're unemployment, prolonged strikes, medical bills not covered by insurance, etc. Divorce, in this case, again, just as FHA, divorce is not viewed as an extenuating circumstance or a circumstance that's beyond your control. So the real key thing here on these extenuating circumstances is any circumstances that are beyond your control. If it's beyond your control, then and you were left with no choice but to file bankruptcy, then you may qualify, and that's something worth having a conversation with myself. So if you're in that situation, by all means, reach out and call me. Again, I can be called or reached at 602-573-3101, or you can email me at valleyofthesunrealestateshow@gmail.com. Now, on VA, on a Chapter 13 bankruptcy, and again, this is when you're paying back the debts, the debts that are owed to the trustee, it's 1 year from the payout period. So if you're in a 5-year plan, then at year 6, from the filing date or the start of your payment plan, that's when you can apply. Let's back up. You can apply 1 year from when you start making your payments to the bankruptcy. Again, though, you have to get the trustee's approval when you're applying for the loan. And sometimes that can be a little tricky, because if you're applying for a loan and you're paying $500 a month in rent currently, and that's what you claimed in your bankruptcy that you're making a payment on, and you're wanting to purchase a house and the house payment's $1,000, a lot of times the trustee's probably going to say, no, I don't think you're going to do that, because you could take that extra $500 and pay me rather than paying your house. So that can be a little tricky there. So not many people, fall into that category, but it can be done if the circumstances are there. So that's 1 year after you start making your payments to the trustee on a VA. And then jumping over to the last segment here, and this is the USDA loan. And USDA has changed their guidelines, not really guidelines, but their maps and their areas in which they cover. And that was changed, or will be changed as of October 1st. But USDA is a program here in Phoenix anyway, in the outlying areas, that is pretty popular. A lot of the newer home communities have USDA capabilities or USDA loans that they offer. So if you're looking at a USDA loan, it's going to be 3 years from the discharge date on a Chapter 7. So once your bankruptcy is discharged on a Chapter 7, it's 3 years on that. And it can be less than 3 years from the day of discharge with acceptable extenuating circumstances. And again, once again, extenuating circumstances are defined a little bit differently under USDA, and they are as loss of a job, delay or reduction in government benefits, if you're a government worker or military or something like that, or other loss of income, increased expenses due to illness, death, etc. Those are extenuating circumstances. and they all got to be temporary in nature. They can't be something prolonged. You can't have something that's going to be, ongoing. So it's got to be something where you've kind of rebound from in order for it to be an extenuating circumstance. And it's got to be, it just has to be beyond your control. So if it's not beyond your control, if you got fired from your job, that's not getting laid off or loss of job. Loss of job is when you're laid off, not fired. Fired is well within your control because you did something to get fired. So being fired from your job doesn't work in any of these cases. And so we got to make sure that the circumstance is behind you and it's not going to reoccur as a temporary kind of thing on a USDA loan. And for that matter, for all of these, it's got to be a temporary situation. So on a Chapter 13 for USDA, it can be 1 year from the date of the repayment. From the date of the repayment completed and the bankruptcy discharged. So that's a little different than these other ones. So that could be after 6 years, and that's why I was getting confused with that VA loan. So this is 1 year after the discharge of a bankruptcy on a Chapter 13. Can be less than that from the discharge date with those extenuating circumstances, right? So it's all about those extenuating circumstances. Now, one thing that, we've kind of gone over all those, and I know there's a lot to take in right there. So we are going to have some of these other things kind of going on. Thank you for the applause there. And so we're going to have, there's another thing here, and I kind of take a deep breath here because every situation is a little bit different. But over the course of the past 5 years, a lot of people were advised by their bankruptcy attorneys to include a home in a bankruptcy. And so there's been a lot of question as to what exactly that means. Now, it's important to note here that when a home in the state of Arizona is included in a bankruptcy, that is considered a foreclosure. Even though you're relinquished of that debt and you're not responsible for that debt, that home was foreclosed on if you include that home in the bankruptcy. And that's why a lot of times the deed of trust is not taken out of your name until about 6 months or so, 4 to 6 months after the discharge date of the bankruptcy. And a lot of times you'll get something in the mail stating this. And I will look on your list of creditors, and if there's a mortgage on there, then I'm going to immediately go to the county records, and I'm going to pull the deed of trust to see when that came out of your name. And from there, on an FHA, it's going to be 3 years. All the same rules apply, right? So, well, it's a little different because then we're looking at not just a bankruptcy, but then we start looking at the foreclosure rules. And on a foreclosure, on a conventional loan, it's 7 years. 7 years on a foreclosure. So when you have a bankruptcy included, or a home included in a bankruptcy on a conventional loan, it's considered a foreclosure. Therefore, it's 7 years from the date of the discharge of that, or date that the deed came out of your name. So I know it gets a little bit confusing here. So it's important to note here, it's not the bankruptcy that's going to take precedence here. It's the fact that the home was included in the bankruptcy, which now is considered a foreclosure because the deed of trust is taken out of your name through foreclosure proceedings. And now it's 7 years from the date of the deed coming out of your name for a conventional loan. Now for FHA, and mind you here, let me back up for just a minute because the rules did change August 16th, 2014 for conventional. But they only applied to deed in lieu of foreclosure and short sales to 4 years. Now, and still, even before the rule change, it's always been 7 years from the day the foreclosure is completed. Doesn't matter how much you're putting down, 20%, whatever. Doesn't really matter. Well, you can get down to 3 years with the extenuating circumstances and 10% down, or even 2 years with 20% down and the extenuating circumstances. But you still have to have those extenuating circumstances. So, in that case, you still may qualify if you have that extenuating circumstance. But we got to prove that extenuating circumstance on there. No longer just money talks and putting money down, and now you qualify for a conventional loan, even though you had a foreclosure. There were quite a few clients that I had that would put 20% down, had a foreclosure, and then would purchase a home 2 years after the foreclosure. And we didn't have to prove the extenuating circumstance in a lot of cases. Well, now you have to prove that extenuating circumstance. Now, on FHA, same rule applies. So if a house is included in the bankruptcy, whether it be Chapter 7, Chapter 13, it's going to fall under the foreclosure rules. Because, again, after the discharge of the bankruptcy, then the original creditor on that mortgage is going to start foreclosure process so they can get the home in their name, and then they can sell it at trustee sale or, on the courthouse steps or whatever they got to do. So it's considered a foreclosure at that point. And so it's going to be 3 years from the date of the deed coming out of your name. So it's not 2 years from the discharge date of the bankruptcy. It's going to be 3 years from the date the deed came out of your name after the bankruptcy. And like I said, it's typically here in Maricopa County, and I think Pinal County, Pima County, Coconino County, a lot of times it's about 6 months from the date of discharge of the bankruptcy before the deed of trust comes out of your name. So in that case, you're looking, generally speaking, about 3 years, 6 months from the date of discharge of the bankruptcy in order to purchase a home under FHA. Now, the nice thing about VA, it's still 2 years on a foreclosure. So it's 2 years, so you got to wait another additional 6 months from the date of the discharge of the bankruptcy. If you had a home included in the bankruptcy, then it's 2 years. And then USDA, it's 3 years from the date of the deed coming out of your name. So little different variations there. Now, it's important also to note here, and this is something that just gets trickier and trickier and trickier, right? So let's say you had a home that had an FHA loan, and you filed bankruptcy, and you included that FHA loan or home in the bankruptcy. In that case there, it's going to be 3 years from the date that FHA pays the claim to the prior lender before you can apply or get a home loan under FHA. So what does that mean? So it's important to note here, FHA is an insured loan. VA is a guaranteed loan. And there's a little bit of a difference there. So what does that mean? So FHA, the government insures the lender against any potential loss. Think of it as like gap insurance. So when the home gets foreclosed on, the bank then files a claim to the government saying, hey, this home, this person didn't make payments on the home, and we're filing our claim. It's kind of like getting damage to your car. You call your insurance agent. Well, the bank calls the government and says, hey, they didn't make their payment. We had to foreclose. We'd like to get our insurance policy. And so the government then will pay a portion to the bank to cover against losses. And it's going to be, once that's paid, then it's 3 years from the date that claim is paid. Now, I'll tell you, it can take upwards of a year before the bank actually files a claim with the government and the government pays the claim. So this one is a little bit tricky. So it's important that if you're in that situation, you have somebody with experience like myself who knows how to kind of anticipate that, not really anticipate that, but just really look out for it and be aware of it and not get you under contract. And all of a sudden you can't get your loan closed because you didn't pass your CAVERS report and some of these other reports that we have to do for government purposes. And you find out the last minute, and meanwhile you spent all this money on appraisals and home inspections, and you're $1,000 to $1,500 deep into this transaction, and now all of a sudden you can't purchase a home, and you could potentially be homeless, and that is no bueno. So we don't want that to happen. So it's important that you talk to somebody like myself with the experience that can help avoid those kind of pitfalls. And again, I can be reached at 602-573-3101 or email me if you're in this situation at valleyofthesunrealestateshow@gmail.com, and I'd be happy to go over your situation. Now, same thing with VA. Let's say you had a VA loan and you included that home in a bankruptcy. Then a lot of times there, VA is you still got to wait your 2 years from the date that the claim is paid, because it is guaranteed, but you may not have full VA benefits. You may only have partial eligibility. And there's a formula that I got to do and calculate to see how much eligibility you have. And you can certainly visit the VA think it's va.gov, and they've got the forms and things there and the calculations. That can be a little tricky. So if you want my help on that, I'd be more than happy to help you determine how much eligibility you have left if you included a VA loan in a bankruptcy. Or if you didn't include a VA loan, even if you had a foreclosure on a VA loan, they're going to restrict you on your eligibility. You're not going to have full entitlement on that. Now, you can get your full entitlement back from VA if you pay back the portion that was lost, the deficiency balance, if you will. But, who's going to pay back $20,000, $30,000, $40,000, $50,000, $100,000 back to the VA? I haven't seen anybody do that. Otherwise, they wouldn't be in foreclosure, right? They would have sold the house or paid down the principal and got rid of the house that way. So a lot of times you're just going to have partial eligibility, and you may not have any eligibility. And that doesn't mean you can't still apply for a VA loan. You can. You just may have to put 5% down, which still isn't bad because, again, you don't have the mortgage insurance on a VA loan. So, it's still a viable option for a veteran. And certainly the waiting period, right? You can either take the VA loan and wait the 2 years or wait the 7 years and get a conventional loan. And with prices going up, interest rates going up, a lot of people say, hey, I'd rather get into what I can right now. And then, it may not be exactly what I want. I may only have partial eligibility. I may only get a $150,000 house instead of a $200,000 house. But I'll sell the house once I'm eligible for conventional financing, and I'll build equity in the current house, therefore allowing me a bigger down payment on the conventional loan once I qualify. So I hope, I know it's a little confusing. There's a lot of stuff here, right? So I think we got it all covered here, though. We did cover everything as far as bankruptcies and life after bankruptcy. So we're going to be looking at these time frames. Big distinction here. FHA is going to allow for a shorter period from a bankruptcy. VA allows for the shortest period. USDA is a little bit shorter than conventional. But in line with what FHA, it's 3 years, so it's kind of halfway in between the FHA and the conventional. So FHA, the real strong point about FHA right now is that they have shorter waiting periods from an economic event. Economic event being those short sales or foreclosures or bankruptcies. And specifically today we talked about, the bankruptcies and the foreclosure. So FHA has that big distinct advantage. That's why a lot of people have taken advantage of that. Lenders like FHA because, like I said earlier, it's insured against any loss. So if I lend on a loan for an FHA loan to you and you don't pay, I'm getting a big portion of the money back through the government because it's government insured. So FHA is a good loan to have, especially if you have some dings on your credit, because they tend to dig a little bit deeper when it comes to credit. In fact, I can go down to a 580 credit score on an FHA pretty easily, where I need a 620 credit score minimum on a conventional loan. So, and some lenders are even at 680 for conventional financing. So FHA does dig a little bit deeper when it comes to that. So I hope this information was beneficial to you. I don't want to stretch it out too long here. It does get kind of boring, no question about it. But if you're in that situation, it's very, very important that you speak to somebody like myself. I've got over 19 years of experience, and I know how to take a turn down and turn it around into approval. Now, if you don't have the 2-year waiting period or the 3-year waiting period or whatever your situation may be, I can't overcome that. But I certainly can give you the straight scoop as to where you stand currently, and then at least start preparing you and getting you on the right track so that when you do have the waiting period, or when you're past that waiting period, you're going to hear the word "you're approved" rather than the words "you're not approved, sorry, I can't help you." And that's never fun. And that's why I think a lot of people just don't want to have that anxiety, and they just don't even apply. So there is life after bankruptcy, especially for home ownership here in Arizona and anywhere for that matter, but more specifically here in Phoenix, Arizona. There is life after bankruptcy, so give me a call today. I'd love to help you out. 602-573-3101, or email me at valleyofthesunrealestateshow@gmail.com. Thank you so much for listening. I really do appreciate it. And again, I hope you got out of this as much as I put into it, which I know it may not sound like a lot, but there is a lot that I put into it. So I am passionate about what I do. So I'd love to hear from you. If you're in a situation, I'd love to help you out. Nothing excites me more than helping somebody achieve their American dream of home ownership. So thank you for listening. Thank you for taking time out of your day. And I look forward to hearing from you. And if you like the show, please, like it on iTunes, or send me an email saying, hey, great stuff. I really do appreciate it. Check out my YouTube channel as well. And that's at YouTube/TheJay Bates, BATES, kind of like the motel. Kind of kid about that. But you can check me out there on YouTube. And I hope you enjoyed. Thank you very much. Take care, everyone. Bye-bye.
Jason Bates, Arizona Mortgage Loan Originator, NMLS 220798, Mortgage Banking License is 092-614, Equal Housing Lender. Sound effects today provided by soundj.com.